A nurse practitioner in Phoenix named Daniela, 31, steady income, no missed payments in her life, sat down with a mortgage lender on a Thursday afternoon in January. She'd been saving for 2 years, had the down payment, had the pre-approval letter from her bank. The lender pulled her credit report, looked at the screen, and said, "Your score is 668. Daniela didn't know what that meant. She knew it wasn't terrible. She didn't know it was 2 points below the threshold that would have saved her over $40,000 in interest over the life of the loan. 2 points, $40,000. That's the system we're taking apart today. Nobody really explains how this algorithm works, not the version that matters anyway. I'm Warren, and when I first deconstructed the scoring formula piece by piece, I realized it doesn't measure what most people think it measures. It doesn't measure financial health. It measures how reliably profitable a borrower is to lenders. And once you see that distinction, everything about the system starts making sense, including the parts that feel unfair. A credit score runs from 300 to 850. The company that built the most widely used version, used by 9 out of 10 major lenders, created the formula in 1989. It's proprietary, meaning the exact weights and calculations aren't public. But the company does disclose the 5 categories it uses and roughly how much each one matters. Here's the breakdown, and here's where Daniela's story starts to make sense. The biggest factor, roughly a third of the total score, is payment history. Have bills been paid on time? This is the only part that measures what most people think a credit score measures: reliability. Daniela had a perfect record here, never missed a payment in her life. Full marks. The second factor, almost a third, is called credit utilization. This is the ratio of how much debt is currently owed versus how much credit is available. And this is where the system starts to reveal itself. Daniela had 3 credit cards, one from Chase, one from Capital One, one from her credit union. Combined credit limit, about $15,000. At the time the lender pulled her report, she was carrying a balance of roughly $4,800 across the 3 cards, about 32% utilization. She'd been told that staying under 30% was the rule. She was 2 percentage points over. And that 2% had a real cost. Here's what most people don't know about utilization, and it's the single most actionable piece of information in this entire video. The 30% rule is a myth, or more precisely, it's a floor, not a ceiling. Researchers who've analyzed scoring data found that the highest scores belong to people with utilization under 6%. Not 30. 6. The system doesn't reward staying below 30, it rewards staying as close to 0 as possible while still showing activity. That's a massive difference, and it changes the strategy entirely. Daniela didn't know this. She'd been making purchases on her cards and paying them down to about a third of the limit each month, thinking she was doing the right thing. She was actually leaving points on the table every single billing cycle, not because she was irresponsible, but because the rule she'd heard was incomplete. And here's the detail that makes this feel designed rather than accidental. Utilization is measured at a snapshot, the moment the credit bureau pulls the data. It doesn't look at averages over time. It doesn't care that the balance was 0 last week or that the payment is scheduled for tomorrow. If the bureau pulls the report on the day after a large purchase posts, the utilization spikes and the score drops. There's no appeal process, there's no context, just the number on that particular day. Daniela had bought new tires for her Honda CR-V 2 weeks before the mortgage application. $840 on her Chase card. She needed the tires. The old ones were bald. It was January in Phoenix and rain was forecast. It wasn't a splurge, it was a safety decision. But that one purchase, sitting on the card at the time of the lender's pull, pushed her utilization from 26 to 32%. 6 points of utilization. 2 points of score. $40,000 of interest over 30 years. From a set of tires she bought to keep her car safe on the highway. She told me later that she spent an entire evening trying to understand how a tire purchase could cost $40,000. The answer is, it can't. But the timing of the tire purchase relative to the credit pull, inside a scoring system that measures snapshots instead of patterns, that can. The third factor, about 15%, is the length of credit history. This one rewards doing nothing. The longer accounts have been open, the better. Average age of accounts matters. And this is where one of the most common financial advice mistakes happens. People close old credit cards they don't use anymore, thinking it simplifies their finances. What it actually does is reduce their total available credit, which raises the utilization ratio, and lower the average age of their accounts. A double hit. Daniela had closed a student credit card 2 years earlier. A card she'd had since nursing school, 8 years of history, wiped from the average the moment the account closed. That closure likely cost her between 20 and 40 points, and she had no idea until the mortgage lender's screen showed the consequences. There's a bitter irony to this factor. The system rewards age, but the only way to build age is to open accounts early and never close them. If nobody explains this to a 20-year-old, they can't go back and fix it at 31. The scoring system punishes people retroactively for decisions they didn't know were decisions at the time. Daniela's closed student card is gone. She can't reopen it. She can only wait for her remaining accounts to age, which takes years, not months. There's no shortcut for this factor, and the system knows it. It's the one lever that can't be pulled in an emergency, which is exactly why it matters so much when the emergency arrives. Factor 4, about 10% up, is new credit inquiries. Every time someone applies for a credit card, a car loan, or a mortgage, the application triggers a hard inquiry on the report, and each one nudges the score down slightly. Multiple inquiries in a short window for the same type of loan, like shopping for mortgage rates over 2 weeks, are usually grouped and counted as one. But applying for a new credit card and a car loan in the same month will produce 2 separate hits. Daniela hadn't applied for anything recently, so this factor wasn't hurting her. But it's worth knowing because it means the act of shopping for better rates, which is the financially smart thing to do, temporarily penalizes the borrower for doing it. The system discourages comparison shopping. Think about who benefits from that. Factor 5, the last 10%, is credit mix. The scoring model rewards having different types of credit active simultaneously: a credit card, an installment loan, a mortgage. The logic from the lender's side is that someone who's managed multiple debt types is a lower risk. From the borrower's side, it means the system incentivizes taking on more kinds of debt. More products, more interest, more revenue for the industry. Daniela had credit cards and a student loan, reasonable mix. She didn't need to change anything here, but the fact that the system would have scored her higher if she'd also had a car loan is the kind of detail that, once you see it, you can't unsee. The algorithm doesn't care about the borrower's financial health. It cares about the borrower's financial entanglement with the lending ecosystem. And this is the part that needs to be said without softening. The scoring system isn't neutral. It wasn't built by a consumer protection agency. It was built by a company that sells scores to lenders. The lenders are the customers. The borrowers are the product being scored. Every design choice in the algorithm, rewarding utilization near zero but not at zero, penalizing closed accounts, dinging inquiries, nudges borrowers toward behavior that generates more interest revenue for lenders. Keep accounts open means keep credit lines available for spending. Don't close cards means maintain the infrastructure for future debt. Show a mix of credit means borrow in multiple categories. The system works. It just doesn't work for the person being scored. Daniela sat with this for about a week after the mortgage meeting. She didn't panic. She didn't rage post about it. She opened a Google Sheet, same move as Marcus from the car trap video, same tool, same instinct, and started mapping the 5 factors against her own report. Payment history, perfect. Utilization, fixable. Length, damaged but recoverable over time. Inquiries, clean. Mix, she had cards and a student loan, decent. Here's the protocol she followed, and it's the same one I'd recommend to anyone whose score is between 600 and 750 and who needs it higher within 90 days. Step 1. Pay down every credit card to under 10% of the limit before the next billing statement closes. Not the payment due date, the statement close date. That's when the balance gets reported to the bureaus, and most people don't know the difference. The payment due date is when the bank charges a late fee. The statement close date is when the bureau takes the snapshot. They're usually 2 to 3 weeks apart, and the one that matters for scoring is the one almost nobody tracks. Daniela called Chase and asked when her statement closed. The rep told her the 12th of each month. She made a payment on the 10th, bringing the balance to about 3%. That single action, repeated across all 3 cards, moved her utilization from 32% to under 8% in one billing cycle. One phone call, one payment timing shift, no new money required, just moving the same payment earlier in the month. Step 2. Don't close any accounts. Don't open any new ones unless absolutely necessary. Let the existing accounts aid. If there's an old card sitting in a drawer, the one from college, the one from the first job, use it once a quarter for a small purchase. A tank of gas at Shell, a bag of coffee at Target, pay it off immediately. This keeps the account active without adding utilization, and it protects the credit history length. Daniela still had her Capital One card from her first nursing job. She started using it once every 3 months for groceries, $20, paid the same week. Step 3. Check for errors. About 1 in 4 credit reports contains at least one material error, a wrong balance, a misattributed account, a collection that shouldn't be there. Daniela found a medical bill from an urgent care visit 3 years earlier, $120 she'd never received a bill for, sent straight to collections without notice. She disputed it through Experian's online portal. It was removed within 30 days. That removal alone may have added 15 to 20 points. And she'd never have found it if she hadn't pulled the report and read it line by line on her kitchen table with a cup of coffee at 9 on a Saturday morning. Daniela reapplied for the mortgage 11 weeks later. Same lender, same desk, same Thursday afternoon slot. The loan officer pulled her report, paused, and looked up. 712. Daniela didn't react at first. She didn't know if that was enough. Then the officer showed her the rate sheet. At 668, she'd been offered 6.8%. At 712, the rate dropped to 6.35. 0.5% sounds like almost nothing. Over 30 years on a $250,000 mortgage, that 0.5% adds up to roughly $37,000 in interest saved. Same house, same monthly income, same down payment sitting in the same Ally savings account, different 3-digit number on a screen, different cost of the next 30 years of her life. She told me later that the moment didn't feel triumphant. It felt absurd. 44 points built from paying down a credit card 10 days earlier in the month, keeping an old Capital One card alive with a $20 grocery charge, and disputing a $120 medical bill she never knew existed. 3 actions, maybe 2 hours of total effort, $37,000. That's the structure of credit scoring. Not complicated, not fair, not transparent. But once the 5 levers are visible, the game changes, because the same rules that punish people who don't know them reward people who do. And the rewards aren't abstract. They're mortgage rates, car loan terms, insurance premiums, apartment approvals. Every financial transaction that runs through the scoring system, and most of them do, costs more or less depending on a number that can be moved in 90 days by someone who understands which levers exist and when to pull them. This connects directly to the series we've been building. Video 1 established the threshold. Videos 2 and 3 showed why income alone doesn't determine outcome. Video 4 and 5 identified the leaks. Today's video is about the system that prices every dollar of debt in a person's life. And the person who understands the system pays less for every dollar they borrow, which means more of every paycheck flows into the building side instead of the extraction side. That's not a hack. That's architecture. That 44-point jump didn't come from earning more money or paying off all her debt. It came from understanding 5 rules that nobody explained to her when she opened her first Chase card at 19. The system was always there. The rules were always the same. The only thing that changed was that she could finally see them. If your score is sitting between 600 and 750 right now, the protocol above will move it. Not gradually, measurably, within 60 to 90 days. And every point above 700 changes the price of every dollar you'll ever borrow. The difference between 668 and 712 for Daniela was $40,000. If you don't know your current utilization ratio, your statement close dates, or whether there are errors on your report, you're playing a game where the rules are hidden and the stakes are real. Open Experian.com tonight, pull the free report, look at the 5 factors, and start with utilization, because it's the only lever that moves fast enough to matter in the next 90 days. Next week, we shift from defense to offense. The exact order to invest money step by step: emergency fund, debt payoff, employer match, index funds, taxable accounts. The sequence matters more than most people realize, and getting it wrong costs years. The architecture continues.